Today I would like to analyze LVMH, one of the largest luxury companies in the world and mostly known for Louis Vuitton. If we take a look at the stock price, we can see in the 1-year chart we are down close to 34%. So we're going to take a look at the financials to find out if this company is undervalued right now. The first thing we can recognize is the huge market cap of 261.6 billion euro. This is the largest company in the luxury by the market capitalization. We also have a dividend yield around 2.42%, which we can see here did increase in a good rate in the last years. So we like to see that. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business, not a declining business. So we can see here in 2020, the revenue was around 44 billion euro. This was a 17% decrease from 2019. So this was related because of COVID. Then in 2021, we had a strong increase around 43%, then around 22% in 2022, then around 9% in 2023, and then we had a decline around 2% in 2024. So we can see we had some strong growth, but now we have a declining revenue in 2024. So this is something we don't like to see, but it's still a check here because we had the growth in the last 5 years. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So we can see here in 2020, the free cash flow was around 6.1 billion euro. Then in 2021, we had a strong increase around 121%. Then we had a decline around 25% in 2022. Then in 2023, again, around 19% decline. Then in 2024, around 30% increase. So overall, we had an inconsistent free cash flow. We also can find the reason for the decline in 2023. So we can see here the capital expenditure increased a lot, around 50%. And even in 2021, it increased around 86% to 2022. So we have the capital expenditure increasing. This means the company investing more money in the business. We like to see that they buy new brands or develop new brands. So it's something positive actually. And then here in 2024, we can see the capex declined around 26%. So this is the main reason for the free cash flow increase, I would say. So overall, in the last 5 years, we had the free cash flow increase. So it's a check here. The next thing we're looking for is the free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we want to see the free cash flow yield very high. And what we're going to do now, we're going to take the free cash flow from 2024. So this is around 10.5 billion euro. We're going to divide it with the market capitalization. So this is around 261.6 billion. So then we're going to get the free cash flow yield for 2024. This is around 4.01%. So this is a good number. I would say it's over 4%. So for this company, I think some years ago, the free cash flow yield was way lower. So I think this number is not bad right now. I think we should also make some future assumptions about the free cash flow. So we can see here the expected free cash flow for 2025 is around 13.7 billion euro. Then in 2026, around 14.9 billion euro. And in 2027, around 16.5 billion euro. So overall, this is an incredible growth. I don't think it's very realistic, but maybe in 2027, we can have a free cash flow around 14 billion euro. So let's take this assumption. So we're going to take the 14 billion euro. Then we're going to take the current market capitalization, 261.6. So we're going to divide the free cash flow again with the market capitalization. So the number we get, 14 divided 261.6. So the number we get is around 5.35%. So this would be a great number. We would have the free cash flow growth in 2027. So overall, I think if this company can keep growing the free cash flow, the valuation right now could be undervalued. The next thing we're looking for is the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number because if the company has too much debt and cannot repay the debt, it can risk to go bankrupt. So we're going to take the long-term debt as well. This is 12.18. Then we're going to add the short-term debt. So this is around 8 billion plus this, so around 11 billion. So then we're going to divide it with the free cash flow. So the free cash flow we're going to use is 10.5 billion. So the number we get is around 2.2. So this means in a little bit over 2 years, we can repay the debt with the free cash flow. This is a great number. It's a check here. We like to see that. And we can take a look at the cash on hand. So how much money this company has in the bank. We can see here around 13.6 billion euro. So this is also a good number, I would say. They can use this to invest in the business, to pay the dividend, and do a lot of things actually. So we think this is a good balance sheet, and I think we like to see that. The next thing we like to see is the enterprise valuation to free cash flow ratio under 25. So this is also can tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see this number low. And what we're going to do now, we're going to get the enterprise valuation first. So this is the market capitalization. So 261.6. Then we're going to add the debt. So the debt was around, let's calculate it quickly. So around 23.2 billion. Then we're going to take minus the cash, 13.6. And then we're going to divide it with the free cash flow. So the free cash flow we're going to use is 10.5. So first, let's calculate the enterprise valuation. So this means it includes the debt and it includes the cash. So it means how much we need to pay for really buying this company. So I calculate this quickly. The number we get is around 271.2. So this means the valuation of this company. It includes the debt and it includes the cash. So this is very important because in the market capitalization is just the shares multiplied with the stock price. But this now includes the debt and the cash as well. So it's a better indication. So now we're going to divide it with the free cash flow. Free cash flow around 10.5 billion. So the number we get is around 25.82. So this valuation is okay, I would say. It's still over 25, so it's not a check here. But I think for this company, it's not very a bad number. And now we can also calculate the number for 2027. So this would be with the free cash flow around 14 billion. So we're going to divide the 271.2 with the 14 billion. So the number we get is around 19.37. So this is already a better number, I would say. So we like to see this number low. So this would be under 25. So it would be a check in 2027. So I think if we can expect the free cash flow to grow, this company can look undervalued right now. The next thing we're looking for is a shares outstanding decrease. This means the company buys back their own shares. We like to see that especially if we think the company is undervalued. So we're going to take a look here and we can see here in the last 3 years, the shares outstanding did decrease, but not much actually. In 2022, around 0.3%. In 2023, around 0.4%. So this is not a lot of shares buybacks. So it's still a check here. We see the shares outstanding decrease, but the buybacks are not in a very high rate. I would like to give my conclusion about this company. So let's start with a positive. So we had some good revenue growth in the last 5 years, especially in 2021. But now we also can see the revenue growth is slowing down. We also had the free cash flow growth in the last 5 years. We have a good balance sheet, which means a low amount of debt and a good amount of cash on hand. We have a free cash flow yield around 4%. This is okay. It's not an indication for undervaluation to me. Then if the free cash flow can continue to grow, probably in 2027, we could have a free cash flow yield around 5.35%. So this is then already looking better. Then we have the enterprise valuation to free cash flow ratio around 25.8. So again, it's not a bad number, but not really an indication for undervaluation right now. If the free cash flow can continue, probably we can see the enterprise valuation to free cash flow ratio around 19.37. So this number would look better already in 2027. But we also need to consider this is a huge company, and this means this company can be more difficult to grow. So especially for such a huge company, it's more difficult to grow the free cash flow and to grow the revenue. Then we also have the risk about tariff. So I think we need to consider this as well, because the tariff from America to France can make the products more expensive. So maybe for the rich people, it's not really affecting because they have enough money, so they will buy the luxury products anyway. But still, I think this is something to consider as well.